Let's talk about timing the market versus time in the market. Do you spend time timing the market or do you spend time in the market? These are two distinct strategies which, depending on the approach you utilize, you could build wealth or you'll end up jeopardizing your opportunity when it comes to building wealth. In today's video, I want us to look at this objectively. Do you time the market or do you spend time in the market? And on this, I'm going to use real examples from the Nairobi Securities Exchange so that you relate to this and you understand what I'm going to be sharing with you. In case you are new here, my name is Afagza Sifuna. I am a finance expert and qualified accountant, bringing you these amazing videos about making money and investing each and every day. So, if you like this kind of content I'm making for you, down there is a button called subscribe. Kindly consider subscribing to this channel because by you subscribing, you're going to be able to catch up on the videos I upload and share with you each and every day. And I will still add it, drop a like on this video. So, let's start by first of all addressing the big question. The question every investor eventually asks, okay, should I wait for the perfect time or should I buy a given stock? That question by itself is a question which makes sense and actually every investor should be asking, right? But then again, the approach you utilize is going to determine if you'll build wealth or not. To give you an example at the Nairobi Securities Exchange, right? As of now, the share of Safaricom is trading at 35 shillings per share. In case you are looking to purchase the share of Safaricom and then you are waiting for when the share is going to reach 30 shillings for you to be able to purchase because you had people typically buy low and then sell high. What if the share never goes down and instead its price increases to 40 shillings, 45 like that over the years? In case you are still waiting, you're going to be losing out on an opportunity. That is an instance of you trying to time the market. And by timing the market in that instance, you'll be delaying your opportunity to invest. And even you might end up losing, because I'm looking at it, yes, you won't lose your money, but it is an opportunity cost which you've forgone. Now, you having understood what time in the market looks like, what exactly is time in the market? Time in the market simply means you investing as soon as you can. And that is why even some of the videos which are made for beginning investors, I typically suggest as an important thing for you, if it is your first stock, it is your first share, just get in. Because most of these things you have to learn them through experience. So time in the market basically means you starting to invest, not sitting on the sidewalks or on the bench saying, I'm waiting for the perfect time. And this is something which can work for you. Of course, we all appreciate the stock market is volatile, yes, but it's something that can work for you. And even just using the example of Safaricom, which I gave, if that first person who is waiting for Safaricom share to dip to 30 shillings before they buy, another one buys at 35 shillings, the moment Safaricom share is going to rise to 40 shillings, okay? And also remember, Safaricom typically pays amazing dividends because even this year, for example, their most recent dividend, they didn't pay a dividend. So imagine you sitting there instead of investing, compared to another person who invests, they're going to see and enjoy the benefit of share price appreciation, maybe appreciating by about 7%. And then Safaricom paying them dividend, again, somewhere between 5% to 8%. Come the end of even 1 year, 2 years, this person is going to be ahead of you in either cash, basically money, or even cash equivalent. And I'm saying so because rarely will you find asset classes out there which supersede the returns of investing in such kind of stock which is rapidly growing or even is a mature kind of like dividend stock which is paying amazing rate of dividend. Because on average, most returns in the market depending are typically somewhere between 6-8%, assuming the year has been good. So that's the difference between someone who times the market and other who spends time in the market. In this example you've seen, the one who did spend time in the market ended up starting to enjoy the benefits of getting into the market instead of sitting on the bench and waiting for the market to favor their conditions. Because rarely will you find the market favoring your conditions. Of course, timing the market is key, as you're going to see I'm going to discuss also in this video, but rarely will you find conditions are perfect and favoring you in the market full time, okay? Clearly, timing the market and being reluctant to invest for years instead of time in the market does hurt your opportunities to really gain from investing. But then again, we've seen, yes, companies out here made a fortune. I mean, people have invested in companies out here made a fortune. For example, a person who invested in Equity Bank, okay, mid-2000, 2006, right now, they have seen their stock increase by upwards of 1,400%. A person who bought KCB shares, okay, in mid-1990s, that's 30 years ago, right now, their investment has increased by over 2,500%, basically 25 folds. That is how amazing investing and waiting for a stock to grow is going to work magic for you instead of just sitting on the benches hoping that the right elite conditions you have in your head are going to work out. But also, there are those instances where timing the market is a key strategy. And examples of those instances are, for example, if you are investing very huge amount of money, okay, you might be timing the market with the goal of you investing in tranches, right? Investing in tranches so that you are investing, but also mitigating your losses. Case in point, you want maybe to invest 10 million in the stock market. You might use this approach as a way of you timing the market to invest. Not, you won't be timing the market not to invest. The bad scenario I'm talking about is the scenario of timing the market and having rigid conditions in your head, thus ending up not investing. And also another scenario where you timing the market might be key is in case you are pegging a decision around a valuation, right? Maybe a company is restructuring, you're thinking about how is it going to be valued, or maybe it's having some challenges which are very pertinent. All these are scenarios which merit you to time the market, not with the goal of not investing, but with the goal of you investing. You're just looking at the right entry signal or the price which you can desire, and then you get in. The key is to invest, not to sit on the benches. You time the market and you don't invest. And so you might be sitting there wondering, between these two strategies, what do seasoned investors use? Seasoned investors out there utilize both these strategies, okay? Because they work together. In that example I've given you, any investors out there would want to catch on growth stocks so that they can enjoy the benefit of their cash growing, right? And also they want to catch on mature stocks so as to enjoy dividends, right? But there are those scenarios where you need some more time just to understand what is going on in the market. Those scenarios, you can time the market, but time the market with the goal of an entry signal. And that is what seasoned investors out there do. And they get into the market once the signal is right. And also, they invest appreciating that their biggest bet is in their time horizon, because compounding is going to work magic to ensure their initial investment grows exponentially. They understand they need to get in as soon as possible, but they get in with the right signal. So, seasoned investors out there combine these two strategies, time in the market and time in the market. Cheers, guys, and catch up in the next videos.